So we are diving headfirst into the pretty high-stakes world of green energy today. And we're tackling a question that has, well, really divided the market.
A big one.
Yeah, is Plug Power. That's NASDAQ, ticker PLUG. Is it the single best stock opportunity trading under $3 right now?
It's an outrageous claim,
Yeah.
especially for a stock that has had such a brutal journey over the last couple of years.
It really has.
But we are unpacking this detailed analysis report that, it doesn't just call for a rebound. It actually sees a massive reversal setup for this leader in hydrogen infrastructure.
A massive reversal setup.
Yeah, and if the company actually executes its strategy, the return potential is, it's enormous.
So our mission today is really to cut through all that noise and figure out if this is for real. We're looking at what is fundamentally a contrarian bet here. The stock recently closed right at $2.19.
And that price tells you everything, right? It tells you that the market sentiment is completely focused on risk, not on the reward. But that's where the analysis provides that initial shock value. Because despite that low price, that $2.19, we see that analysts still maintain a high price target of $7 on the stock.
$7.
$7. And if you do the math, hitting that target, that's a potential gain of 219%. I mean, that's why we're even having this conversation.
Right. It just transforms from, a stock correction into this high-octane growth story almost overnight if that target materializes.
Absolutely. And to understand how we could get from $2.19 to $7, our deep dive really needs to cover two interconnected areas.
Okay.
First, the technical setup. What are the charts actually showing us about this potential bottom? And second, and I think this is more critical, the fundamental shift. We have to analyze the specific, really challenging targets the company has set for itself.
Scaling and profitability. Yeah.
The big ones. Scaling, and most importantly, achieving that profitability.
Okay, so let's unpack this. Let's start with the technical thesis, which the analysis calls spring-loaded.
I like that.
The stock's been beaten down severely, and this 219 zone is described as critical. So my question is simple. What evidence do we have that this is a sustainable floor and not just, a temporary pause before another drop?
That is the question. And the technical evidence really points to a strong defense being mounted in that immediate lower range.
Okay.
If we look at the trading history just over the past few months, the stock has been, and this is a quote, hammering out a floor between about $1.60 and $2.
$1.60 and $2. So that's the zone.
That's the zone. And what that suggests is that every single time the stock dips into that range, institutional and retail buying interest, it just steps in heavily to support it. That establishes a really crucial foundation, both psychological and mechanical.
So that area has become the established support. That gives investors a very clear line in the sand when it comes to risk.
Precisely. And this floor formation is also happening at the same time as other technical indicators that just scream consolidation. We're seeing all the necessary preconditions for a major reversal.
Like what?
First, the relative strength index, the RSI, which, it measures the speed and change of price movements, it's cooling off dramatically.
Okay.
This usually indicates that the overwhelming selling pressure that just drove the stock down is finally exhausting itself.
And what about the trading activity? Is volume still high or is it dropping off?
That's a great question.
Yeah.
The volume is stabilizing. So when you see a low RSI combined with stabilizing volume, not panic selling volume, it often suggests the market is just taking a necessary breather.
Right.
It's consolidating before it decides on its next big move. This is the moment the spring gets loaded.
Let's talk about that spring-loaded analogy then. Plug Power is a highly volatile stock. Everyone knows that. So why is that volatility actually seen as a positive factor in this setup?
Well, the analysis argues that the volatility is actually key to the potential reward here. When a stock that typically moves wildly, a stock known for 10% swings in a single day, when it finally finds a firm floor and enters this consolidation phase, the eventual bounce back can be incredibly rapid.
So it's not a slow climb.
No, it suggests the repricing won't be a gentle climb at all. It will be an explosive move once the market gains confidence that the worst of those cash burn fears are maybe in the past.
So if the spring is coiled and it's ready to launch, we need specific triggers. What are the resistance levels the report identified as the immediate confirmation signs? What numbers open that path toward the $7 target?
The technical report gave us two immediate thresholds to watch. First, reclaiming $2.35.
Okay, $2.35.
That's the critical short-term resistance. If the stock can push definitively past that, it then sets its sights on $2.50. And once $2.50 is breached, the path opens up much, much wider. That makes $3, even $4, very attainable targets in the near to medium term.
So the whole thing is framed as a classic contrarian buy the dip setup.
That's exactly it. You're buying the pessimism, really, in anticipation of a fundamental shift.
That does make a compelling technical argument. But, as we all know, technical patterns are pretty meaningless if the underlying business is fundamentally broken.
Of course.
This stock has been hammered for a reason. Cash burn, massive capital expenditure. We have to look at the other side of this coin.
And what's so fascinating here is how the source material links that technical reversal to the fundamental roadmap looking out to 2026.
So it's not just a chart play.
No, it suggests this is a timing play. The technical bottom is forming at the exact point where the company's long-term business model appears to be accelerating toward, well, viability.
Okay, let's look at the current growth numbers then. Despite the stock price being in the doldrums, is the company actually succeeding at selling its product?
The data suggests really robust real-world demand. Our report detailed some significant positive growth, noting that their Gineco electrolyzer business grew by a massive 46% just last quarter.
Wow, 46%.
46%. And for context, Gineco, that's their division focused on building the actual infrastructure. The systems that separate hydrogen from water, which is the foundation of the whole green hydrogen economy.
46% growth in an infrastructure business is phenomenal.
Yeah.
I mean, that shows that despite all the financial market skepticism, industrial, commercial customers, they're voting with their wallets.
They're buying the products. And what does management say about maintaining this momentum? They are maintaining a very aggressive and clear outlook.
Right.
They've reaffirmed a revenue target of $700 million for 2025. This shows they are focused intensely on scaling up operations, manufacturing, distribution, and user applications. They're spending money to grow, not to shrink back.
Okay, but here's where the skepticism has to come in. Revenue's good, but cash burn is bad.
Mm-hmm.
The biggest criticism has always been the necessity of constantly raising capital, which, leads to dilution. So how does the company plan to pivot from being a cash furnace to a sustainable entity?
That is the core risk, and the analysis addresses it head on. The pivot, it relies on a dual strategy. One, continued scaling to leverage fixed costs, which we see in that 46% growth.
Okay.
And two, an aggressive internal cost-cutting initiative to optimize their operational expenses right across the board. They have to prove they can scale efficiently.
So let's identify the critical catalyst then. The single event that would justify this risk profile and potentially trigger that flight to $7. What is one fundamental goal management has to hit?
It all comes down to profitability, specifically the targeted timeline for reaching positive EBITDA.
EBITDA, earnings before interest, taxes, depreciation, and amortization.
Exactly, and it's a crucial metric for these high CapEx infrastructure companies. Since Plug Power has massive upfront costs for building plants and equipment, EBITDA tells investors whether the core operations are actually making money before you factor in non-cash expenses like depreciation.
And what is the timeline for that shift? When do they expect to hit that?
Plug is specifically targeting positive EBITDA by the second half of 2026.
2026.
And the source material emphasizes the absolute significance of this date. If, and this is the big if, they transition from being a cash-burning growth company to one that is EBITDA positive, the analysis argues the stock will be fundamentally re-rated by the market. In their view, the stock won't be $2 anymore.
Because the existential risk.
Right, the existential risk of running out of money will be largely gone.
Okay, so we have a clear technical setup showing a floor has been established, and we have a very clear fundamental deadline, that 2026 profitability target. Now, let's transition to what the pros are saying, because this scenario brings us squarely into the territory of the asymmetric bet.
That's absolutely right. And the current market cynicism, which is driven by that persistent cash burn, has kept the consensus rating at a hold.
A hold?
Yeah, analysts acknowledge the risk, primarily the execution risk involved in hitting that aggressive 2026 profitability target.
Yet, that $7 target remains. That's the key here.
Exactly. The fact that the high price target is still $7 shows that the upside scenario, the one where management just flawlessly executes their plan, is still fully priced into the high end of analyst expectations. And that gap creates this tremendous risk-to-reward imbalance.
So let's walk the listener through that asymmetric bet calculation from the report, because understanding this is crucial for anyone even considering this high volatility play. Our buying price is currently around $2.19.
Right. And the analysis was clear about the downside. If the absolute bear case materializes, meaning the company fails to hit its targets and is forced into more dilution or operational distress, the low target was set at 75 cents.
75 cents.
So that means your risk is losing about $1.44 per share.
A painful but measurable loss. Now let's compare that to the high target, $7.
So in the upside scenario, you stand to gain $4.81 per share. This is the very definition of an asymmetric bet. The potential magnitude of the reward is roughly 3.5 times the magnitude of the immediate calculable risk.
But we do have to acknowledge the one risk factor that financial analysts always point to with companies like this.
Dilution.
Dilution. The low target of 75 cents assumes a certain capital structure. If they have to raise capital again and again, that affects the stock price regardless of execution.
And that is the caveat. This is a bet on execution. This opportunity is really only attractive for investors who are comfortable with extreme volatility and who are betting confidently on management's ability to execute a costly, complex plan over 2 years without having to issue massive amounts of new shares.
Right, which would just change the whole per share value calculation.
Completely.
Okay, so what does this all mean for you, the listener? Let's summarize the 2 absolute necessary conditions for this massive reversal setup to succeed and deliver that $7 outcome.
Okay, first, on the technical side, that $1.60 to $2 floor, it must successfully hold.
It has to hold.
That validates the current bottom and keeps that spring-loaded technical thesis alive.
And second, the fundamental condition is that transition to generating cash. Management has to hit that positive EBITDA target in the second half of 2026. That is the proof point the market needs to stop pricing the stock as a speculative venture and start pricing it as a growing infrastructure leader.
And for immediate, actionable insight for those of you tracking this, the immediate level to watch for confirmation that the spring is uncoiling is that $2.35 resistance level. A clear break above that is the very first signal that the reversal is truly underway.
The report makes it clear. This stock is a compelling, contrarian buy if you fundamentally believe in the long-term future of the green hydrogen economy. But let's leave you with this one thought to explore further. We discussed that incredible 46% growth in their Genieco electrolyzer business last quarter. Given that growth rate, which implies soaring real-world demand, does the sheer momentum of their sales figures alone justify the risk profile while you wait for that potentially long, difficult path to 2026 profitability? Is 46% growth enough to compensate for a 2-year capital burn? That's really the high-stakes balancing act you have to consider.